Today we are joined by Jason Kim, the Portfolio Manager of the Nikko AM Tyndall Australian Share Wholesale Fund. Jason, can you tell us a little bit about your background and the history of the product?
I started off as a qualified actuary. I did actuarial work for about 3 years, but during that time I've always had a fascination and an interest in investments, in particular equities. So after that 3 years of doing actuarial work, I actively pursued to try to get into the investment industry. So I spent about a year in investment research and quite a few years at Deutsche Bank. And it was during the year 2000 I had the opportunity to join our current team. It was the team was called Tyndall back then. It's now Nikko AM. And I've been here for almost 16 years now. During that time, I've been involved with quantitative research, risk control, and obviously being an actuary, insurance stocks was my forte. And I've covered that sector for a very long period of time. And I have to admit that I do think my background gives me a unique angle and some insights into the insurance space. I've also been a portfolio manager within the team since late 2001. Started off managing the concentrated strategy. And during March 2014, I was asked to run jointly the Wholesale Share Fund with Brad Potter, and I commenced managing that during May. So it's been almost 2 years managing the Wholesale Share Fund alongside Brad Potter. The history of the fund, it's been around since March 1995. It's had a very strong track record. Now, it is managed on a value philosophy. That's what we do. All of us, the whole team, believe in value, and we believe value is what will outperform in the long run, and the track record actually speaks for itself. The core of the team that currently sits here, we've been around together in essence since late 99, early 2000, and I joined what was then called Tyndall back in 2000.
Jason, you have a large team in place. Can you explain how the investment team interacts? What are your specific responsibilities and how the investment team is aligned with investors?
We do have a fairly large team. There are 11 of us in the equities team. A few of us do have dual roles. In fact, of the 11, 5 of us are portfolio managers. And we all are research analysts as well. So all the portfolio managers do cover companies, and I do think it actually helps to provide better insight into how we manage each of the portfolios. It is fairly flat, as I was saying before, and we do go through a fairly robust review process to ensure that when we go through a stock, that we have a very strong investment case and we can understand all the various downside and upside scenarios. In regards to how we are aligned with investors, one of the first things I should state is that the equities team, the business itself is a joint venture. It's a 50-50 joint venture with Nikko Asset Management. So in essence, half of the equities business is owned by the staff. The vast majority of the team have equity in the business. Now we've paid our hard-earned to get in there, and lots of years of blood and sweat to get in there. So in that regard, very much we want this business to succeed, and the way to succeed is to produce good, strong performance for our clients.
I would now like to spend a little bit of time on the research process behind Nikko AM, and in particular with reference to the Nikko AM Tyndall Australian Share Wholesale Fund. Can you explain the investment objectives behind the strategy?
The investment objective of the Nikko AM Tyndall Australian Share Wholesale Fund is to outperform the ASX 200 Accumulation Index by 2.5% per annum over rolling 5 years.
Can you talk through the investment philosophy behind the strategy?
The investment philosophy behind our strategy is value. We very much believe that value will outperform over the long run, and certainly throughout history, value has always outperformed. And the real reason for that is due to the behaviour of investors, the foibles or the weaknesses of humans. Now, people tend to get really excited and buy into fads and causes speculative behaviour, but in reality, that doesn't work, and value always comes to the fore as people eventually realise that a company that produces sustainable cash flows and earnings and rewards shareholders with dividend over time is what really truly outperforms.
You manage a highly concentrated portfolio of between 20 to 35 companies. Can you tell us a little bit about the stock selection process behind your strategy?
The first thing we do is we have a thorough research on all the stocks that we cover. It's approximately 150 stocks that we do cover. It involves a lot of tie kicking. We actually go out, visit the companies, talk to their competitors, their suppliers, and then put together an understanding of the company and a valuation. The valuation process itself is fairly in-depth. So we look at modelling the balance sheet and the profit and loss, and we come up with a resulting valuation. Now, when we talk about value, we are an intrinsic value manager. We're not a naive or academic value investor. So we don't just look at historical earnings and just buy stocks which have the lowest price to earnings. That's not what we do. We actually try to understand the company and come up with a fundamental valuation. So what that means is we take into consideration the quality of the company, how predictable its earnings are, and also whether it has some unique advantage that can last for some years. And that results in a valuation for the company which takes all that into consideration. So that's our anchor, and to the extent it trades at a significant discount to that, it can be considered for inclusion into the portfolio. So in essence, up to 35 stocks in the portfolio where we look to put in the most attractively valued, but also take into consideration pragmatic issues such as risk to ensure that we have a broad spread in there. And we try to understand the various downside and upside scenarios in each of our holdings or stocks we may consider for inclusion.
You manage a highly concentrated portfolio. Can you explain how you manage this risk?
Yeah, risk control is obviously very important for us. Regards to this portfolio, I suppose you can look at risk from two different perspectives. You've got the quantitative or the scientific way of looking at things, and you've also got the qualitative or subjective or judgment and experience. That's what it's really all about. On the first side, the quantitative side, we do have various risk tools that we do use. And the obvious one there is to ensure that we don't have undue concentration in any one industry group. That is, not to have all your eggs in the one basket. So we do have gates around our industry exposures, as well as to ensure that we don't have too much in any one stock. So we will take a very strong view on stocks, but of course you need to have a gate around that as well. We do also look at something called tracking error to ensure that we understand how different we are to the ASX 200 index. So where we do have a very strong view, we will have a higher tracking error, and we just need to be aware of how far away we are from the index, and given the positions we have, do we have the conviction to be in there? But generally, we are a high conviction manager and we'll have a higher tracking error. On the subjective side or the qualitative side, now we have a very large team. We've been together for a very long period of time. And in fact, I think the average industry experience of our team is in excess of 18 years. And we've been together for in excess of 12 years. So a lot of collective experience can go in there. And what we do look for is try to understand things such as the quality of management. Now, by meeting management, you can take an assessment or make an assessment of whether they've got the goods to really take the company forward or whether they will take the company backwards. Also, just from talking to various industry experts, you can kind of form a view on what the environment is like for those various companies. And just having an understanding of where we are in the cycle can help us frame our positioning. If we do believe that the value will be a little bit deeper for a certain company before we see the upside, we may hold back a bit or maybe just reduce our position a little bit. And when we have greater confidence and conviction, then we might take a bigger position in that stock. So that's pretty much how it works. I mean, that's only like a taste of what we do. There certainly is a lot more than that.
What are some of the key features of the investment strategy?
Yeah, we tend to be generally fully invested at all times. We will have a little bit of frictional cash. It may move up and down a little bit, but generally fully invested. Regards to how we invest the money, it is a very much a benchmark aware strategy. So we do look at managing the portfolio to outperform the ASX 200 index and to manage the downside relative to that. Regards to some of the other attributes of the portfolio, we did say it was a value style that we do manage to. The other thing to note is that while we do tend to focus on the larger stocks within the ASX 200 for liquidity reasons, to be able to get in and out of them, despite that, we do tend to have a bias to the mid-cap, say the 51 to 100 largest, not so much the top 50. And the reason for that is that we tend to find that that's generally under-researched, and as a result, a lot of opportunities do tend to arise in that mid-cap space.
What's the recommended time frame for an investor?
The recommended time frame for investors in this strategy is 5 years. The reason for that is we are fully invested in equities, and equities as an asset class is one of the more volatile. So we do think a 5-year time frame is appropriate for this strategy.